We go to chapter 39, current account, balance of payments. Structure of the current account. The meaning of the balance of payments. The balance of payments is a record for all economic transactions between the residents of the country and the rest of the world in a particular period, over a quarter of a year, or more commonly over a year. These transactions are made by individuals, firms, and the government. Money coming into the country is recorded as credit items, and money leaving the country as debit items. The first section of the balance of payments, and the best known, is the current account. So when we talk about balance of payment, basically we're talking about economic transactions between countries. So these transactions, how is it done? Transactions are done not just for individuals. Government is part of the transaction. Firms are part of the transaction. So all in all, the total transaction, the total economic transaction, which involves individuals, firms, governments, with the rest of the world, is called balance of payments, the record. I think that is clear. Yes. So for the records, the first section of it is what we call the current account. So for the current account, this is where we talk about the real balance of payments. But you have to take note that when we talk about the balance of payment, we have the credit section and the debit section. Money that comes into the country is recorded on the credit section of the balance of payment, and money that goes out of the country is recorded in the debit section of the balance of payment. So we start with the components of the current account. So for the current account, they said the current account shows the income received by the country and the expenditure made by it in its dealing with other countries. So as soon as you do exports, you receive income, money comes in, right? So you record it in the credit side. Then we talk about our expenses, our importation now, what we buy from other countries, from foreign customers, or from foreign businesses, or from foreign governments. We record it also on the debit side. So what are the four components of the current account? We have the trading goods. For trading goods, they said this covers exports and imports of goods, including cash, cars, food, and machinery. These are what we call merchandise exports and imports. So the first section is talking about trading goods, which are physical goods. Laptops, whatever they are trading goods. So if our exports of trading goods exceeds our imports of trading goods, we call it trading goods surplus. If our imports of trading goods exceeds our exports of trading goods, we call it trading goods deficit. I think that is clear. Yes. So we go to trading services. They say, as its name suggests, this part records payments for services sold abroad and expedition of services bought from foreign countries. So our import and export of services. Our import of services are our expenditures. Our export of services are our income. So when we talk about export of services, for example, like foreigners making a tour in Libya. So with UK citizens making a tour in Libya is an export of service. Did you get it? Yes. So that's an example. So if our export of service exceeds our import of service, we call it trade in service surplus. If our export of service is less than the import of service, we call it trade in service deficit. I think that is clear. Yes. So that's about that. So we go to, now they said together the first two components give the balance of trade in goods and service. So trade in goods and trade in service is our balance of trade in goods and services. That is clear. Then the other component is the primary income. Why do we call it primary income? We call it primary income because this income is earned by people working in different countries. So look at what they said. They said this covers income earned by individuals and firms. It records two categories of income flow, which are compensation of employees and investment income. Compensation of employees include wages, salaries, and other benefits earned by residents working abroad, minus that earned by foreigners working in the home economy. So when we talk about our primary income, let's talk about the compensation of employees. The compensation of employees are the total amount foreigners, like the total amount Nigerians abroad are making, minus the total amount foreigners in Nigeria are making, is what we call compensation of employees. Do you get the point here? So that's for compensation of employees. Then we have the investment. For the investment, we're talking about foreign Nigerians having different companies abroad, having shares abroad. Do you understand? They get dividends, yes or no? Yes. This is an investment income. Are you with me?
Yes.
Or interest. Maybe they have capital abroad that they make interest from. So look at what they wrote. They said investment income covers profit, dividends, and interest received from abroad minus profit, dividends, and interest paid abroad. Investment income is earned on foreign direct investments. These are multinationals. And financial investments, including shares, government bonds, and loans. If, for example, a multinational company sends profit out of the country back to its own country, it will appear as a debit item in this section because money is going out of the country. It's a debit. Then the receipt of dividends on shares in foreign companies and interest on loans made to foreign firms will be on the credit items. So what do you receive from foreign countries in terms of receipts, in terms of shares, in terms of dividends, in terms of interest,
Yes.
will be recorded on the debit, on the credit side of the income statement, of the primary income. On the credit, yes. Yeah, interest received, yeah.
Yes, sir. Yeah.
Those that goes out from multinationals out of our country is recorded on the debit side. So go to the secondary income. This is also called the current transfer. So this is transfers of money, goods, and services. Transfers of money, goods, or services which are sent out of the country or come into the country, not in return for anything else. We call it secondary transfer, like the aids. Like, oh, Turkey gave Ghana $5 million, or Libya gave Ethiopia $10 million. These are secondary income because there is no exchange of goods and services on them. Unlike the primary income, which means services was rendered before that interest was paid, or shares were sold, shares were bought before dividends were paid. Yes. For secondary income, no, nothing like that. I think it's clear.
Yes.
So here they said, it essentially covers gift items, include charitable donations, which I already explained. So the calculation of deficits and surpluses on the current account of the balance of payments. The balances of the four components are summed up to give the current account balance. Also sometimes just called the current balance. A current account surplus arises when the value of the credit items exceeds the value of the debit items. If the value of the debit items is greater than the value of the credit items, there's a current account deficit. So there's a difference between there's current account deficit and current account surplus. We have current account deficit where the value of our current account on the debit side exceeds the credit side. That is current account deficit. If the value of the current account credit side exceeds the value of the current account debit side, we have a current account surplus. Trade in goods surplus, trade in goods deficit. Trade in service surplus, trade in services deficit. Current account surplus, current account deficit. I think that is clear.
Yeah.
So here, okay, let's go down. Changes in exports and imports.
Yeah.
They said,
yeah.
So changes in exports and imports. There are numbers of factors that influence the value of a country's exports and imports. This includes, one, the country's inflation rate. If the country has a relatively high rate of inflation, domestic households and firms are likely to buy a significant number of imports. The country's firms are also likely to experience some difficulty in exporting. A fall in inflation, however, would increase the country's international competitiveness and would be likely to increase export and reduce imports. So the first thing we're talking about is inflation rate. If the inflation rate is high, it affects exports and imports. So because firms and individuals will not be able to buy as they want to buy. A country's exchange rate. A fall in country's exchange rate will lower export prices and raise import prices. This will be likely to increase the value of its exports and lower the amount spent on imports. The value of exports will increase, but not the volume. You hear what I'm saying? They said this will be likely to increase the value of its exports and lower the amount spent on imports. So if the exchange rate falls, a lot of people would buy. Foreign businesses, foreign customers will want to buy.
Volume will increase, volume will not.
Volume will increase, but value will not.
Yeah.
But here they talked about increases the value of its export in terms of volume. That is what they are talking about. Did you get the point here?
Yes.
But when you check about the amount of money that they're going to make, it will be less. Do you get it?
Yeah.
So that's about inflation rates, which is a factor that can influence import and export. Exchange rate is a factor that can influence import and export. The third point here is productivity. If productivity increases, a rise in productivity is likely to lead to a greater number of households and firms buying more of the country's products. So export should rise and import will fall. If productivity increases in the country, what does that imply? It means we are producing more. Our output has increased in the country. So we don't have to depend on foreign businesses or importation. So local businesses will do more. We will buy more of our products and we'll do more of export than doing imports because of productivity. That's clear. Quality. A fall in the country's quality or a fall in the country product quality would shift supply to shift demand for your country, for your products elsewhere. That means foreign customers will stop buying from you because your product lack quality. So they won't buy from your country anymore. And that is not good. So export will fall. Marketing. The amount of exports sold is influenced not only by their quality and price, but also the effectiveness of domestic firms in marketing their products. Similarly, the quantity of imports purchased is affected by the effectiveness of the marketing undertaken by foreign firms. How you are able to create awareness globally will increase the demand for your goods. If domestic businesses or domestic firms are able to we're able to successfully advertise their products or market their products, foreign customers will buy. That will increase their exports. But if they can't, they won't. That's why you see, when you watch football matches, you see different adverts, different marketing strategies, so that you can be aware of the product, so you can buy. Because they know football, everybody watches it. That's what they're saying there. Is it clear?
Yes.
Domestic GDP. If income rises at home, more imports may be bought. Firms are likely to buy more raw materials and capital goods. And some of these will come from abroad. Households will buy more products, and some of these will be imported. The rise in domestic demand may also encourage some domestic firms to switch from the foreign to domestic market. If this does occur, exports will fall.
Foreign to domestic.
Yeah, domestic GDP. If GDP of the country increases,
yeah,
you will do more of imports because there's money. Did you get the point they're making here?
Yeah.
You will do more of imports. But the problem is that they said here, the rise in domestic demand may also encourage some domestic firms to switch from the foreign to domestic markets. If this occurs, export will fall. What are they saying? Because the GDP of the country is increasing. People are getting better, right?
Yeah.
So they buy more. So what they used to buy, the demand or the aggregate demand will increase. As a result, firms might not be able to sell abroad anymore because the country is already taking demand. Demand has also already, if demand increases in the country,
yeah,
if demand for products increases in the country, firms that are thinking of exporting might not be able to export because there's nothing left to export. That is the point.
Yes. So they are
if domestic GDP increases,
yeah,
it means people get better. Demand in the country would rise.
Yeah.
So firms might not think of exporting.
high living standard, yeah.
They might not think of exporting. That's the point. Foreign GDP. If income abroad rises, foreigners will buy more products. This may enable the country to export more. So for foreign GDP, if income rises abroad, they will do more of imports. That means a country that does exports will sell more.
Yes.
Trade restrictions. A relaxation in trade restriction abroad will make it easier for domestic firms to sell their products to other countries. Export will rise.
Yes.
Is it clear?
Yes.
Now go to the causes of current account deficits. The factors influencing changes in export and import gives an indication as to what can cause a current account deficit. One is income at home and abroad. The deficit arising from low incomes abroad or a high income at home can be referred to as cyclical deficit. If there's high income at home and there's low income from abroad, it will lead to cyclical deficits because people that they are supposed to depend on,
so they will import more.
They will do more imports.
Yeah, than exports.
Than exports.
Yes.
And as a result, exports will be reducing because there's no income from abroad that would make them to buy.
There's no one gonna buy.
There's no one going to buy. So it's cyclical. So that's what we call cyclical deficit. Do you get it?
Yeah.
Import is increasing, but export is not.
Yes.
That's the point. A high exchange rate can also cause a current account deficit. This is because it will mean high export prices and low import prices. There may also be what we call structural problems. This can include a problem with the products manufactured by firms in the country, cost incurred to produce them, prices at which they are sold, and strategies adopted by marketing them. This can give rise to what is called structural deficits. A current account deficit may also be the result of a deficit on primary income or secondary income. So another problem here is high export prices and low import prices. Price of export are high.
Yeah.
People are not going to buy. Price of import is less. People will buy more. Do you understand?
Yes.
But what is the problem about this? You that you are buying more, you won't be able to buy, you won't be able to export raw materials anymore. Do you get it?
Yes.
Some countries are exporting raw materials, but the price of export are high. So they won't be able to export raw materials or finished goods, but they will be able to import. But how do you continue to import without exporting? So this is structural. Do you get the point here?
Yes.
Do you understand what I'm saying? Let's take Libya as an example.
Okay.
Libya, though, because the price of export is high, Libya is unable to sell petrol, fuel, or petroleum or crude oil to other countries. But the price of import is less. Libya is able to buy goods from other countries down here. But where will Libya be able to pay for these things if it's not exporting?
So it's only, I guess,
That is structural.
They don't get, so they don't get the income that they're expecting. They don't
Spend.
match.
Yeah. So expenses continue to increase. Revenue stop coming. Deficit.
Yes.
Structural deficit. Is
Yes.
it clear now?
Yes.
So we go down. The consequences of a current account deficit. A current account deficit may mean that the country is consuming more goods and services than what it's producing. That means you are doing more imports than exports.
Okay.
Or yes, that's what it's basically. This is sometimes referred to as a country living beyond its means. That means you are living beyond your means. A current account deficit can also mean a reduction in inflationary pressure, and there will be a fall in aggregate demand. So a current account deficit could be as a result of a fall in aggregate demand. So people are not buying as they used to buy. Do you understand?
Yes.
Okay. So a current account deficit, however, means that output and employment is lower than possible. If more goods and services were to be produced at home, more workers would be employed. So there's current account deficit here because employment is falling, output is falling. So the significance of current account deficit depends on its size, duration, and the cost. So how big is the current account deficit? How long is the current account deficit going to take? And what is the cost? What is the reason for this current account deficit? So all these things will determine the consequence of current account deficit. Do you understand what they're saying there?
Yeah.
So how important is this current account deficit will be based on the size of it, the cost of it, and the time at which it's expected to stop. If it is a short time, so we could work around it. So they said a deficit has been caused by the import of raw materials and capital goods. Changes in income or a high exchange rate is likely to be self-correcting over time, irrespective of its size. Imported raw materials and capital goods will be used to produce goods and services, some of which will be exported. Recession abroad will not last, and with a rise in income, the country can export more to foreign countries. A deficit on the current account will put downward pressure on the exchange rate. If it does fall, export will become cheaper and import will become more expensive. As a result of a deficit may be eliminated. So if it's a short term, for example, using recession, if it's as a result of recession will never last. It will be for a period of time, which means it can be corrected. So what do you do because it is recession? You stop importing. You start investing in capital goods. Because when you invest in capital goods, those capital goods will produce other goods. And as soon as that is done, output increases in your economy, then you'll be able to export. So these are short term. So they won't last. They can be corrected. Do you get the point I'm making here? We're talking about current account deficit that is based on recession.
But it will take time, right? If you invest in capital goods.
Yeah, but it will take time.
Yeah.
But after a while,
yeah,
these things would bring prosperity to the country.
And then it will be a protected country.
So it will bring prosperity to the country.
Yeah.
Do you understand? So the point is, whatever the case might be, countries should invest more on capital goods than consumer goods. Do you get it? So a deficit may also be the result of more primary and secondary income. So a deficit may also be the result of more primary and secondary income leaving the country than entering it. So if primary income and secondary income are leaving the country, now they are receiving, then it will be deficit. Primary income, that means a lot of you are paying more of dividends to foreign businesses. You are paying more interest to foreign countries, to foreign investors. You are not receiving any. It will be current account deficit.
Yes.
If you continue to gift countries, gift them, you run into deficit. And you are not receiving. That's what they are saying here. Do you get it?
Yes.
Another reason for deficit, he said, a deficit arising due to a lack of international competitiveness is more serious. That is when we are not doing exports. Leaving the country than entering it. Is more serious. This is because it will not be self-correcting. If first cost of production are higher due to lower productivity, or the quality of the products produced are poor or the products made are not in high world demand, the deficit may persist. In this case, government may have to introduce policies, particularly supply side policies, to improve the country's trade performance. So here they're talking about deficit as a result of lack of international competitiveness. If there's lack of international competitiveness, it might be as a result of poor quality products, high cost of production, or low productivity. So these things, government have to take charge. Government have to come up with policy, supply side policies. That is the point. Clear?
Yes.
So go to the causes of current account surplus. A current account surplus may arise for a number of reasons. One, a low exchange rate. When there's a low exchange rate, exports will increase.
Yes. Because
it becomes cheaper. High quality of domestically produced products. Because you have high quality products, demand for your product will increase. That will improve your balance of payment current accounts. Yeah. High income abroad. When you receive more incomes abroad, primary or secondary, it will give you a surplus in your balance of payment current accounts.
Yes.
Low cost of production. If your cost of production is falling, it means you can charge a lower price. It gives you international competitiveness. You can sell more. High investment income earned abroad. Libyans have a lot of businesses abroad. Money comes in. That will give them current account surplus. The receipt of high workers' remittance. Libyans abroad they're getting huge salary. They put it back home, current accounts, because it's going to be on the credit side of your current account. The consequences of current account surplus. So if these things are happening, what are the consequences? An increase in the current account surplus will increase an economy aggregate demand, and so may lead to a rise in the real GDP and high employment. More money will enter the economy than will leave it, and higher aggregate demand may cause demand pull inflation. If the economy is operating close to full capacity, it also means that the country is consuming fewer products than it's producing. So if an economy is operating a floating exchange rate, an increase in the current account surplus may result in an appreciation in the exchange rate. This is because demand for the economy's currency will exceed its supply. So the consequences of current account surplus are round it up. So for current account surplus, it means the credit side of your current account is exceeding the debit side of your current account. So what is the consequence of this? The consequence is, one, they said there will be a rise in the real GDP. Because at that point in time, we're talking about more primary income and more secondary income flowing into the country. So the country, money is flowing into the country than money going out of the country. So what are the consequences? One, the real GDP will increase. The GDP of the country will increase, that the national income will increase. Two, there will be high employment rate. Why? Because a lot of investment is happening in the country. Aggregate demand will increase in the economy because there's flow of money. But what are the negative impacts to this? It might lead to demand pull inflation because a lot of people, the living standard has improved. A lot of people has money. A lot of people have money. So what happens because they have money? They want to buy more. So aggregate demand will increase, leading to demand pull inflation. That's the fourth point. Now they said, if which will lead to inflation, we talked about that, right? Then if the country is operating close to full capacity, it also means that the country is consuming fewer products than it's producing. So that means if the country is already in full capacity, that means all resources are fully employed. This means that the country is doing more imports.
More imports?
Yes, because you're already operating on the full capacity and your demand is increasing. Where are you getting the product from?
Imports, yeah.
So it will later go back to deficit. Do you get the point here?
Yes.
And if the country is operating a floating exchange rate, because money is coming into the country so much, that means the demand for the country's currency is increasing. As a result of that, the country's currency will appreciate. And if the country's currency is appreciating, demand for the country's currency will exceed the supply. Do you get the point here? So these are the consequences of current account surplus. It will lead to it will increase the GDP, the real GDP. It will increase employment opportunity. But the problems are, one, high importation rate, because especially if the country is already at its full capacity and the demand is increasing, that means the country is doing more imports. Two, the country will be having currency appreciation, which is not good, which is good at some extent. But when we look at it, because money is flowing into the country's currency will be in demand, which means demand for the country's currency will continue to increase than the supply, which will later lead to what? Appreciation of currency. The value of the currency will continue to rise because demand is increasing more than supply. Is it clear?
Yes.
We go to policies to achieve balance of payment stability.
Yes.
So if the balance of payment is not stable, increasing, floating, it's fluctuating. So what will government do? Over time, a government is likely to want to achieve balance of payment stability. It will not want to see large and persistent current account deficit or large and persistent current account surplus because both of them are not good for the economy. So as mentioned above, so a current account surplus means that, let's just see what government should do. To avoid, measures to correct a current account deficit. A government will seek to reduce the current account deficit by using policies, measures designed to reduce imports or increase exports. So to reduce current account deficits, government could use reduction in importation or increase in exportation. Policies like
monetary policy.
Monetary policy.
Monetary
policy for foreign exchange, yes. Interest rate, yes.
Interest rate.
Or supply side policy to increase productivity, which will increase exports. Clear?
Yes.
Let me see. Exchange rate here, they talk about exchange rate, increasing income taxes, increasing interest rates, pushing up rates of indirect tax. These measures may reduce imports and may give domestic firms a great incentive to export, and they find it harder to sell at home. Is it okay? I think that is done anyway. Then we go down. Let's see. In lower average cost of production, well, whatever it is, to increase exports, you need to think about productivity. You need to think about how to give domestic firms the opportunity to produce more. For you to increase output. Output will increase if domestic firms are increasing if the domestic firms are given the opportunity to do that.
Yes.
Government could give subsidy too. Government could subsidize to reduce the cost of production. So that's all about it. Do you get it?
Yes.
But they said it will also avoid some of the disadvantages of other measures, including retaliation. So if government is doing these things, government should also think about retaliation. If you are doing it to Turkey, Turkey might do it back to you. So if you are restricting them,
they might restrict you.
So that's the point. Is it clear?
Yes.
So to correct current account surplus, if a government wants to reduce current account surplus, there are numbers of measures it could use. These are essentially the reverse of measures to reduce a current account deficit. It would revalue a fixed exchange rate or to encourage an appreciation of a floating exchange rate. It also if government revalue a fixed exchange rate, it means the value of the currency becomes higher. So at that point in time, it will buy more of imports than exports. Do you get it? Yeah, there's current account surplus.
Yeah,
current account surplus as a result of more exports than imports.
Yes.
So government wants to correct it. For government to correct it, government would revalue the currency. So the price of exports will rise. So exports become less. Imports increases. So the surplus will become deficit and balance.
Yes.
Do you get what I'm saying here?
Yes. Yes, I'm getting it.
Government wants to correct current account surplus. For government to correct current account surplus, government might revalue the currency. If government revalues the currency, what happens? Export prices increases. People will not do export, but you can do more import. But because you're having less import, that is why, it's to balance. I think that is clear.
Yeah. Government
might cut income tax. If government cut income taxes, import will increase, demand will increase.
Yeah. Yes.
We'll go to the questions. They said, which of the following is an import of a service into Indonesia? Import of a service into Indonesia.
B. Yeah.
Indonesia is buying cars. Import of service.
Service
into Indonesia.
No. Hey, French firms selling insurance.
Tourists visiting Indonesia. I just explained that to you.
Oh, yeah.
Sorry. Import of service into Indonesia, right?
Yeah.
French firms.
Yes, French firms.
Yeah. That's export.
Because that's exports, yeah.
Yeah, thank you. It's French firms, yeah. A. Question B2. Mexican firms sell more oil to the USA and buy more banking service from the UK. How do these changes affect the Mexican balance of payment?
Sell more oil to USA and buy more.
Trading goods will improve.
Trading goods, improve. Trade and service.
Buy more banking services. Trading services.
Worsen, yeah.
For Mexicans, yes.
Yeah. So it's B.
Yeah. Question 3. Which of the following items is included in the current account of the balance of payment?
Credit card, the balance payment.
Yes.
Hey.
The payment of interest on foreign loans.
I don't know.
The purchase of shares in foreign companies, the sale of government bonds to foreign residents, the setting up of branch. What's the answer? Included in the current accounts.
Current accounts.
Yeah.
B. Purchase of shares in foreign companies.
When you purchase shares from foreign countries, it will be recorded in the debit side. Yes, B.
Yeah.
Question 4. Which of the following is most likely to reduce a deficit on the current account of the balance of payment? Reduce deficit.
Reduce deficit. Reduce deficit. Deficit, which is exports less than imports.
To reduce deficits.
Yeah, just less exports. D.
A rise in the value of the currency. If there's a rise in the value of a country's currency.
No, there will not be the exports. Because, no, it's not D. Arising consumer confidence.
What is deficit? Deficit as a result of what?
Exports are less than imports. That's the surplus. Exports are more than.
In the
See,
current
yeah.
account. Credit side of the current account exists debit side of the current account.
And the current account. B.
A fall in income tax. Listen,
Yeah.
a fall in income tax means that income will increase.
Yeah, because imports, there will be more imports. Yeah, I didn't read I thought it was about balance B.
No. So it's B.
Yeah.
That's done.
Yes. Finished.
Yeah.